Good day, fellow investors. A company that has been intriguing many of my research platform subscribers is Porsche. So I've just started with this list from my subscriber suggestions, and Porsche is one of those, and I would like to go through it. Bjorn asks here about the business, the holding, the connection, the values there, also about Lilium, which we might discuss in another video to touch on it. So I did a discussion there on Porsche, said that it should be 40–50% lower, and that was 5 years ago, 4 years ago. And since then, now it is just 25% lower, but it didn't go far, and it is okay that I didn't chase it there. In the meantime, not much has changed there. The Porsche, I don't know how to say it in German, still owns it. The dividend is stable, but even with the discount to the holdings value, it's much lower than the Volkswagen 8% despite the discount. So that is also something to think about when it comes to these holding companies. If the dividend is 4%, and they should just send you through the 8% dividend, that should be 12% given the discount, then there is a big question mark on what they are doing with the money. Of course, they say they have some debt, that's why they can't pay out the dividend, but okay, what's the strategy of the holding company? Global investment platform. So this is not just dividend through platform. They are investing, they have investment strategy, diversification, and pursuing long-term value creation. So it's not really just a holding that's there to just give you the dividend through. And therefore, okay, reliable dividend policy. Volkswagen's dividend is going up and down like this. They want to further invest, which means the dividend gets cut, and they will reduce financial debt, which means even lower dividends for a while. Now the question is, how big should the discount be? If you look at here, the discount to net asset value is 47%, 5 billion, so a little bit less. The analyst median target 22 billion when it comes to the market capitalization. But if they would just distribute the stocks to shareholders, just the Volkswagen stake and the Porsche stake of the company, not the holding company, just the Porsche company, then that would be 33 billion, while the market capitalization now is 15 billion. So why are not they just doing that, giving the shares, forgetting about the holding company? Well, because this is Europe, these are families, and it is about control. Now, they say that they are trading below net asset value because of the high concentration of investments. That's not right. The net debt position, okay, but that can be dealt, so that's also not right. Potential liabilities from legal issues, no, because the legal issues affect Volkswagen, not the discount. So this is German Scheiße, not to say in English. What's the real deal there? Well, the real deal is that the Porsche Pich family doesn't want to do so because it's a matter of control, power, and inheritance. In one word, it's a matter of European family, legacy, or just ego. It is that. So they want control, investments, feeling power, being on the boards, and also if you just give the dividends, the shares to your kids, whatever, they start selling, living crazy lives. So it's a huge matter of control, not of economic rationality. Close the holding, give the stocks away, everybody happy, everyone made 15 billion and hasta la vista. No, they want to keep it. So that's what has the discount there for already 4 years. The same thing was going on when I looked at this 4 years ago. Nothing has changed. So the second question is, Now that we know why the discount is there, will the discount change there? So yes, they're going to distribute the dividends for Volkswagen, but so they say, will they invest in other things? This is a huge discount issue, because then the money doesn't flow to you but to other things that they want to control. Then if you look at the company, okay, we have Porsche, a small dividend yield, everything looks good, great brand, good cash flows, fairly valued, let's say, nothing wrong with this company in the luxury brand, which is doing well globally. But also when it comes to these companies, people forget that this is investing in China. 30% of revenues are from China. So this is a Chinese investment, but apart from that, P ratio around 10 in a good market looks good, fairly priced. If there is a recession, of course, it goes down. That's normal for automotive companies. Now, when it comes to Volkswagen, I think that 2022 was one of the best years for cars. They didn't reach their goals. They are profitable, yes, but not that much. And if you look at the finances there, okay, what are cash flows? 6 to 8 billion. So 6 billion in great times, P ratio of 10, not this, 10. Okay, that's fairly okay for a car company. Here it was extremely risky, and now it is more fairly priced. Now people are waiting, saying, Sven, but this should now rebound, go back to here. Yes, if we have another great year for cars, amazing year for cars, amazing year for cars. And keep something in mind, this was the best decade for car makers in history. Zero interest rates. What you do with zero interest rates? Do you save your money in a bank or you buy a car? So that's something that people forget when it comes to looking at these things. And they have financial targets, and these financial targets will only be met if the economy goes well, everything goes as planned, everything goes linearly up. Let me ask you a question. When has that happened in the history of humanity? Never. So that's also something to think about. That also explains why the stock is going down. And if you look at what they are doing, growth and improvement stories everywhere, they have the ambition long term for even higher dividend payments, but this is what they make, 30% of the P ratio of, because they need to reinvest and everything. So the P ratio is actually 15. And they can say whatever about the EBITDA, the liquidity. Well, it is how much money you pay in dividends, how much do you need to invest to keep your market. And you can see here Porsche is doing well. The rest is not that good. And even if I say that this has been the best time for car makers because of low interest rate, which ballooned their balance sheet, that is crazy there. So if the European Union doesn't give zero interest money, free money, this will be a totally different story. And I remember writing my book somewhere here, I said, in recessions, that's when you buy here below 30, and those that do that do well. So buy car companies in recessions is my message. And if we look at the stock, so these are cyclicals, ups and downs, ups and downs. Now it's much better, of course, to buy at 100 than at 200. For those that bought at 200. But now at 100, it still can go lower, because maybe they will make 5 billion, maybe they won't make any billions. If there is a global slowdown, recession, cost increases, that pushes, changing customer preferences, and you can see the ups and downs here, also before the shenanigans with the diesel. So that is life. You can see that it's normal for a car company in a bad period to fall 65% from, let's say, averages. So it can go to much lower. That's the risk and reward. And similarly there also the discount might close, might not close, you never know. It is about power. So if you want to invest in power of that family maybe find some inheritance, marry, and get rich that way, they will likely hold on to their power. Thanks for watching. I'll see you in the next video.